Failed auctions. Explained. Entry, invalidation, target. Most traders see a move into the high or low of the session and assume breakout or reversal. That is usually the wrong question. The better question is this: did the auction complete or did it fail? Because when an auction fails at an extreme, the opportunity is not in predicting. It is in recognizing rejection early, defining structural invalidation clearly, and targeting the most logical magnet back inside the auction. That is what this video is about. We are going to break down what a failed auction actually is, why it matters, where the entry comes from, where invalidation belongs, and how to think about targets in a professional way. And if you want the full execution framework behind ideas like this, that is exactly what Trading on the Edge is built for. The channel gives you the concepts. The book gives you the complete operating model behind them. What a failed auction actually is. A failed auction happens when price pushes beyond a meaningful extreme, but cannot find acceptance there. That is the key. Not just a wick, not just a reversal candle, not just a level that happened to hold. A failed auction is an attempted extension that does not attract continued participation. The market probes higher or lower looking for new business. If that higher or lower price is accepted, value can migrate and the auction can continue. But if price is rejected and cannot hold beyond the extreme, the market often rotates back toward the prior area of trade. That is why failed auctions matter so much. They are not random reversal patterns. They are information. They tell you that the market attempted discovery and did not get paid for it. And when that happens at a meaningful structural location, the asymmetry can become very attractive. Why most traders misread them. Most traders enter too early. They see price tagging a prior high, a session extreme, overnight high, overnight low, or the edge of a profile, and they immediately fade it just because it looks stretched. That is not a failed auction. That is anticipation. And anticipation at the edge is expensive when the auction has not actually failed yet. A market can look extended and still continue much further if acceptance develops. Professionals are not fading extremes because they are emotionally uncomfortable with higher prices or lower prices. They are waiting for evidence that the auction was rejected. That distinction is everything. The edge is not at the extreme alone. The edge is at the extreme plus confirmation of rejection. Where failed auctions tend to matter most. Failed auctions are most useful when they happen at meaningful locations. That could be the prior day high or low. It could be a weekly high or low. It could be the overnight extreme. It could be the edge of a balance area. It could be a composite high volume node edge, value area edge, or another structurally relevant reference where participation matters. Location matters because not every local high or low means anything. The market is an auction. It rotates constantly. You need the failed probe to occur somewhere that actually has contextual weight. A failed auction at a random mid-range area is usually weak information. A failed auction at a clear structural extreme is very different. That is where the risk can be small, the invalidation can be logical, and the rotation target can make sense. What confirmation actually looks like. Confirmation is simple in principle, but traders often make it too vague. You're looking for evidence that price could not hold beyond the extreme. That can show up as a push through the high or low that immediately returns back inside the prior range, a rejection of the extreme followed by inability to sustain trade above or below it, a sweep of liquidity followed by aggressive response in the opposite direction, absorption at the edge followed by loss of initiative from the breakout side, failure to build acceptance outside the auction. The exact tool can vary. You might use footprint information, delta, tape behavior, or just clean price response around the level. But the core idea stays the same. The market attempted to move beyond the extreme and failed to sustain it. That is the information you trade around, not the touch. The failure. The entry model. The cleanest failed auction entries usually come after rejection is already visible. There are two practical ways to think about entry. The first is the aggressive entry. This happens once price has pushed beyond the extreme, rejected, and come back inside the prior auction. You are entering on the early confirmation that the extension failed. The benefit is better price and tighter risk. The drawback is that you are entering earlier, so you need to be more precise and more selective. The second is the conservative entry. This happens after rejection is visible and the market confirms further by accepting back inside the prior range or structure. In other words, you let the market prove that the breakout side has lost control before you commit. The benefit is better confirmation. The drawback is that your price is not as good, so the trade needs enough room to the target. Both approaches can work, but in both cases, the entry should be tied to rejection and re-entry into the auction, not just to the fact that price touched an extreme. That is a big upgrade for most traders. A simple short example. Let's say NQ pushes above the prior day high during regular trading hours. A lot of breakout traders buy that move. A lot of early fade traders short too soon. But the better read is to watch what happens after the push. If price trades above the prior day high, cannot hold there, and quickly rotates back below that high, that is your first sign the auction may have failed. If order flow also weakens on the breakout attempt, and the market starts accepting back below the prior day high, the short idea becomes much more interesting. Now your entry is not based on opinion. It is based on a failed attempt at higher prices. That is a completely different trade. Where invalidation belongs. This is where many traders destroy good ideas with bad structure. Invalidation should go beyond the area that proves you are wrong, not at some arbitrary tick amount, not based on what feels affordable, not based on a fixed dollar stop copied from another setup. For a failed auction short, invalidation usually belongs beyond the failed extreme. Why? Because if price gets back above that rejection area and begins to hold there, the auction may not have failed after all. It may simply have paused before continuation. That is the structural reason the trade no longer works. Same thing in reverse for a failed auction long. If the market failed below a meaningful low, rejected it, and rotated back higher, your invalidation belongs beyond that failed low zone. If price gets accepted back below it, your read was wrong or early. That is what structural invalidation means. The stop is not there to satisfy your risk preference. The stop is there to represent the point where the trade thesis breaks. That is one of the core ideas in trading on the edge. Good trading is not about forcing risk to be small. It is about taking trades where structure makes risk logical. How to think about targets. Targets should also be structural. Once a failed auction is confirmed, price often rotates back toward the most obvious magnets inside the prior auction. That might be the session value area. It might be VWAP. It might be the point of control. It might be the opposite side of a local balance. It might be a prior high volume node or another area where two-sided trade previously occurred. The logic is simple. If the market could not find acceptance outside the extreme, it often returns toward the area where trade was previously accepted. That is where targets come from. For a failed auction at the high, your first target is often back into the range, then toward value, then possibly deeper into the opposing side of balance if the context supports it. For a failed auction at the low, same idea in reverse. The best target is not the biggest possible move. It is the most logical magnet relative to your entry and invalidation. That is how you keep the trade asymmetrical without becoming unrealistic. The common mistake with targets. Many traders see a failed auction work immediately and then assume the market must fully reverse the entire day. Sometimes it will. Many times it will not. A failed auction does not automatically mean trend reversal. It often means rejection of a specific extreme and rotation back into accepted trade. That may be a modest move or a major move depending on context. So the question is not, how far can this go? The better question is, where is the next logical magnet? And is the reward still strong relative to the structural stop? That keeps you grounded. When not to take the trade, this is important. Do not force failed auction trades in the middle of the range. Do not force them when the location is weak. Do not force them when there is no actual rejection, only a pause. And do not force them when the invalidation is too wide relative to the nearest logical target. A setup can be conceptually correct and still be a bad trade. That is what serious traders understand. The goal is not to trade every failed auction. The goal is to trade the ones with meaningful location, clear rejection, clean invalidation, and logical target structure. That is where low variance execution starts to appear. What professionals focus on. Professionals are not asking, can I call the top? They are asking, was there a meaningful probe? Did it fail to find acceptance? Has price returned back into the auction? Is invalidation clear and structural? Is there a logical target magnet? And does the trade still offer asymmetry after confirmation? That framework is much more durable than memorizing patterns because it is built on auction logic, not aesthetics. Final summary. So let's bring it together. A failed auction is an attempted move beyond a meaningful extreme that does not achieve acceptance. The opportunity is not the extreme by itself. The opportunity is the rejection of that extreme. Entry comes after evidence that the market could not sustain trade beyond the level. Invalidation belongs beyond the area that proves the auction did not actually fail. And targets should be based on the most logical magnets back inside accepted trade, not on hope. That is how you turn failed auctions from a vague chart pattern into a structured execution model. And that is the difference between guessing and trading with framework. If this is the way you want to approach markets, subscribe and keep going deeper into the channel. And if you want the full framework behind concepts like failed auctions, acceptance, rejection, value, and execution, Trading on the Edge is the affordable professional resource designed to connect all of this into one complete model.